Hello, welcome to another episode of Money Talk Sundayz. I'm your host, Stevie Bee. And today we're going to dive into a topic that's been making headlines all around the world, the stock market, and its seemingly unshakable relationship with the U.S. debt ceiling. Cue the music. Welcome to Money Talk Sundayz. I'm your host, Stevie Bee. For those watching on YouTube or Rumble, just go ahead and hit that like, share, subscribe button right there. And for those listening in on Spotify or your favorite podcast streaming platform, go ahead and hit that like and share button. Subscribe if you want to be a subscriber. And let's get right into it. The U.S. debt ceiling and its correlation with the stock market. Now, if you're a seasoned investor, you're likely aware of the turmoil that ensues every time this topic resurfaces. If you're new to the scene, don't worry. By the end of this podcast, you'll have a clearer understanding of why this little thing called the debt ceiling is causing such a big stir. Now, first things first, what is the debt ceiling? Well, simply put, it's the maximum amount of money that the U.S. government can borrow. Now, why would the government need to borrow money? Obviously, to fund a myriad of things from military operations to social services, infrastructure, and everything in between, which is why they try to cut a lot of the social services. Anywho, that's a rabbit hole for another time. Now, there is a catch. The debt ceiling needs to be increased periodically to keep up with the spending demands of a growing economy. Without this increase, the government can default on its debts, causing economic uncertainty and a ripple effect that can send waves across global markets. Now, let's connect the dots between the debt ceiling and the stock market. When there's uncertainty around the debt ceiling, investors get jittery. The possibility of a government default sends shivers down their spines. It's important to remember that the stock market is, in essence, a reflection of future expectations. When investors are faced with potential default, they predict a bleak future, leading to a sell-off of stocks, which in turn causes the market to struggle. The stock market thrives on stability and predictability. The back and forth around the debt ceiling creates an environment of uncertainty. Investors cannot plan for the future if they're unsure whether the government will default on its obligations or not. Moreover, if the debt ceiling is not increased and the U.S. defaults, the credit rating of the country may be downgraded. This downgrade can increase borrowing costs, not just for the government, but for corporations as well. And this can directly impact their profitability and, by extension, their stock prices. And then, the trickle-down effect, it'll affect us as well as retail investors. Now, the debt ceiling also plays a significant role in fiscal policy. If the ceiling isn't raised, government spending will need to be cut dramatically. One of the first things that will be cut will be social services such as Medicaid, food stamps, other government welfare programs. They will be cut first. So, this could lead to a slowdown in economic growth, another factor that could negatively impact the stock market. In conclusion, until the debt ceiling issue is resolved, the stock market will struggle to rally. The uncertainty and potential negative consequences of a default create an environment that is not conducive to a thriving stock market. It is important to keep this in mind as you navigate your investment journey. Remember, investing is not just about picking the right stocks. It's also about understanding the macroeconomic factors that can influence the performance of those stocks. And with that being said, we've reached the end of this episode of Money Talk Sundayz. Thank you for joining on Money Talk Sundayz. As always, invest smart, stay informed, and happy trading. Peace out.